Hey guys, it's Keenan Starks, your local real estate agent and multifamily specialist, coming to you with your source of multifamily information and education to keep you informed of what's going on in the market. I've read all of these forms here, all of these reports here, and I broke them down into this convenient, quick newsletter for you. So let's get straight into it. If you look at the overall numbers of what's going on in the market here, if you look at the vacancy is down 4.4%, which is down 16 basis points quarter over quarter, but it's up year over year, and we'll talk about that a little bit later. We can see the rent changes here is down 3.3% overall. That's year over year. We'll talk about that a little bit later as well. With 274,000, a little bit over 274,000 units completed, and about a little over 134,000 units absorbed. We are at about 135 billion in acquisitions total for the last 4 quarters. So that's what those numbers look like. If we look here locally in the Twin Cities area, our occupancy rate is about 92%, which is down 3.3% from last year. If we look at the effective rents are 1,321, which is up about 1.1%. We've seen rents consistently increase year over year, and I think this year may be a little less increase, but it's still going to be somewhat of an increase. When we look here locally in the Twin Cities, our numbers here at occupancy are about 92%, which is down about 3% from last year. Our effective rent is $1,321, which is up about 1.1%. The interesting number here is the concessions, which is about 16%, which means that apartment owners and landlords are giving about a 16% concession compared to last year, which is up 128%. So we can see that due to probably COVID, and where landlords are probably enticing tenants to move in and giving more of an incentive, like 1 month's rent free, or half off of your deposit, something like that. So those what those numbers look like here locally. So let's look at the employment trends. We see what's going on nationally. We hope that the employment rate returns to normal fast, but we see that it is getting better. It may not be as fast as we want, but at the end of October, we were at about 6.9%, which is down 1% for the quarter. But it's been going down consecutively for the last 6 months. And we look here locally at Minnesota, our unemployment rate is about 4.6%, which is down 5.9% from the quarter. So Minnesota has taken a drastic decrease in their unemployment rate, which is awesome, but they still say it's going to take about 3.5 to 4 years to return to pre-COVID numbers, and that's what the experts are saying. So we ask ourselves, are people paying rent? Because I know a lot of people are curious. Are the tenants going to be able to pay their rent? A lot of landlords are curious. Are the tenants going to pay their rent? And we do know that, of course, this crisis has affected a lot of people, but we do hope for the best for people. So as we look at what the NMHC president says, which is the National Multifamily Housing Council, they say November's opening rent payment figures show that the additional support apartment residents receive over the summer, coupled with generous, innovative approaches put into place by property owners and managers, continue to provide renters with some degree of security against the economic distress facing communities throughout the country. So pretty much what they're saying is that the actions that landlords and the governments put into play and they're doing are actually helping tenants reach their financial obligations and their housing situations. So this is a great move for housing, I would say, because it's giving people alternative solutions compared to just evicting people. So as we look at the housing rent payment tracker from NMHC, they say that in November, the first half of November, from November 1st to the 20th, 90% of households paid their rent. Let's just say multifamily households, tenants, or people that live in apartment buildings. 90.3% of those people paid a portion of their rent, which is down 1.6 from October, which is 183,000 household difference from October 1st to October 20th. So our numbers are still relatively high with the 90%. I would say that's a pretty decent number, but it's down from last month for 183,000 households. The average rate of rent has taken a little bit of a compression there in quarter three. We can see that in quarter three, our national average rent rates are down 3% from the first quarter, but it's down 3.3% year over year. And that's according to CBRE. And CBRE also says of the 6 U.S. major regions, the Midwest has the highest percentage of markets with quarter-over-quarter rent growth. Only Chicago and Minneapolis had rent declines. And what that means is that, the Midwest is doing pretty good, but the major gateway cities like Chicago and Minneapolis have got hit a little bit harder than the surrounding areas when it comes to rent declines. So let's go into the national multifamily vacancy numbers here. If we look at vacancies, we can see that we are down to about a 4.4% vacancy rate, and that's down 16 basis points for the quarter, and that's about up 80 basis points year over year, actually. So if we can expect to see that actually rise due to seasonality here in the winter seasons, but ultimately it's going to stabilize in quarter one 2021, and it's expected to recover fully late 2021 according to CBRE. Okay, so let's look at the national average vacancy rates here. We can see that Class A has consistently had the higher vacancy rate, which is the orange line here, and Class B and Class C are being the leaders in occupancy. So if we look at the local supply here, we can see that the completions are pretty strong. They're consistently strong over the last few quarters, and we can see that at the end of quarter three, we ended at about a 3.8% vacancy rate, which is up 10 basis points quarter over quarter. And in September, it was the highest it's been since 2016. In the end of quarter three, where there were about 2,800 units finalized, with about 15,400 coming up into and flowing through 2023, with 4,100 of those being in urban areas. Even though we have a lot of property a lot of units coming to the market, we are about 11th highest in the nation when it comes to vacancy. On the flip side, in September, the 12-month sales average risen about 11% year over year to a new high of 149,000 per unit. And locally, the cap rate is maintaining at around the higher 5% range here locally. When we look at what's going on in the financial section, I'll go over these points here. We want to pay attention to how more conservative lending has been in quarter three. Also, rates remain relatively low and unchanged in quarter three. Fannie Mae and Freddie Mac continue to dominate the multifamily debt sector. With their largest product being their refi loans, so a lot of people are jumping on board trying to get those low rates. Delinquencies on rent payments and loans. Well, delinquencies on mortgages. Delinquencies on multifamily mortgages are low despite a decline in revenue. Underwriting has been more conservative in quarter three, and we can see that their loan to value lending has pretty much reached new lows here, lows that it hasn't seen in a long time here. So a lot of people ask me, is this going to be another recession? This looks like 2008. Is there going to be a flood of foreclosures? Are there going to be, a huge dip in the economy? Are my home values going to go down? We're going to touch that. We're going to touch bases on that now and tell you the difference of what's happening now and compare it to 2008. Okay, so first let's go over a quote from Ivy Zelman. Ivy Zelman is a real estate analytic firm, and they have thousands of reports on what's going on in the market. If you don't know about them, I suggest you go to their website, Zelman and Associates. Great information, and they look over a lot of information when it comes to the real estate market. And she says the likelihood of us having a foreclosure crisis again is about 0%. So I'm going to listen to her. I'm going to take that advice, and I'm going to just go over this information that I have for you here when it comes to 2008 compared to now. Okay, so if we look at what's happening with the numbers of what happened with multifamily housing values compared to the great financial crisis, and we compare that to what's happening today with the COVID pandemic, we see that in the great financial crisis, it took about 6 quarters for multifamily property values to lose 24.7%, and it took it about 8 more quarters for that to recover pre-great financial crisis numbers. So in all, it took about 14 quarters for that entire peak to trough to happen. When we look at multifamily and how it performed compared to other sections of multifamily real estate, and we see that retail did extremely well, but multifamily did second best when it came to how hard it got hit and compared to how fast it recovered, and ultimately how great it recovered. We can see that in the multifamily recovered second strongest compared to retail, compared to when you're looking at other things such as industrial, office, and hotel. When we look at the employment cycle of the great financial crisis compared to COVID and the pandemic, we can see at the great financial crisis, it took it about 24 months for the employment to return to the numbers that it did before the great financial crisis happened. And you compare that to COVID, experts are predicting and forecasting for the employment numbers to take about 12 quarters, 3 years, or 3 to 4 years to recover. When we look at the rent cycles and what happens with the rents, we can see that in the great financial crisis, it took it about 13 quarters for the rents to return to normal compared to COVID, where experts are forecasting a 9-quarter recovery. Okay, so let's take a look at what the Federal Reserve has to say about what's going on in the multifamily world. They say the data from the survey of the business uncertainty, SBU, suggests that the road forward is going to be a tough slog. Business holds tepid expectations for year-ahead employment and sales growth. Expectations are in fact so tepid that based on the latest average projection, it will take firms more than 4.5 years to recover from their pre-COVID employment levels. So what that means is that we're not totally out of the loop here yet, even though things are getting, sort of back on track. It's going to take some time for us to get back to where we were, And when we take a look at what the Fed's outlook on the U.S. economy, we look at Bernanke's interview with Marcus and Millichap, and these are some key takeaways from his interview. He says that with the help of the vaccine, the economy might recover more quickly, and we see that the vaccine is actually here now. So we're hoping to see a great recovery now that the vaccine is here. The Fed's policy alone won't alleviate the pain, and they do stress a new stimulus package. The crisis may have suspended a lot of millennials from their home buying plans, and there's going to be some demand for time to come. We can see that the furlough and unemployment rate has affected some people's housing and also some of their home buying plans. So some of those people may have a lot of pent up demand for home buying. So we can see that demand to hold steady for years to come. That's what he's saying. And he says that if you create more supply, then demand will go down, which is economic 101. Economic damage may continue on to 2022, more than 2021. It may go on to 2022, but the vaccine will promote a faster general recovery than the great financial crisis. And we are in a different financial terms than the great financial crisis, that we don't have the same financial issues, but that's the overall look of what Bernanke says. We do see that the Fed is continuing to dump a lot of money into the supply during the health crisis, and we can see here in 2020 that number has risen drastically. So we ask ourselves, where do we go from here? What now? What is going to happen to the multifamily realm? There's a lot of news out there, and I just want to give you guys some information of what I see, and hopefully it will help you out. Like, again, I'm not an attorney. I'm not a financial planner, so do consult your team of experts before you go out and buy a big, huge property or make a big, huge investment. So what we see with the future of what's going on into 2021, we can see that according to CBRE, that they forecast that there's going to be a 33% in growth in investments in the multifamily world. So with that 33% increase of growth, that is 33% more than 2020, but that is not as much as 2019. We see that the Fed's keeping the low rates here is adding a lot of more capital in return, that it is reducing pressure when it comes to pricing, and it also is helping all around with helping investors get the adequate financing that they do need to make the investments. And what else? With the stimulus package, I say that's going to help out a lot of tenants pay their rent and help them, at least for the short term, help them accomplish short financial goals, which is going to be good, for the economy. I do hope the low density, less expensive suburbs, submarkets did very well in 2020, and they're probably going to be positioned to do the best in 2021 as well. That's what a lot of experts are seeing, and that's what I'm seeing as well. especially in the Midwest and in the Southeast areas, according to CBRE. They also said that they're expecting and forecasting a 6% rent increase in 2021. Also, they're expecting vacancies to return to normal in 2021. Experts are forecasting that the demand will increase in 2021 compared to 2020, but not as strong as 2019. Class A properties will recover a little bit slower when it comes to rent increases and stability, and also with vacancies. But Class B properties are poised to do the best in 2021. Class C will probably be second, right there behind Class B properties. But if you look at the overall economy and what's happening with unemployment, we can see that Class C properties and the tenants in Class C, they've probably been hit the most with the unemployment, but they've also had the most assistance when it comes to, getting the protection that they need to keep their homes and the protections that they need that the government has been giving them to help them pay their rent. But also we can see that Class A properties and the tenants in Class A, they probably have more options since they probably do have more income. And we see that the unemployment level with the higher wage earners didn't get hit as bad as the lower wage earners. So we tend to see that the higher wage earners and the Class A properties or the Class A tenants tend to have more options. You can always go down in class, so a Class A person can buy a Class B property, or they can downgrade to a Class C property, or just downgrade. But we can see that with the Class C properties and the tenants in Class C and the lower income wage earners, they don't have that option. So they tend to take the help that the government is giving them, and they tend to, help or work with the landlords as long as they can to avoid eviction. And we can see that, that's been very helpful with the eviction rate and with the percentage of people that can pay their rent. And we do hope to see that a lot more people can keep their homes, and we don't want to see a flood of foreclosures. But we do see, as that restriction is coming down, that there may be some flood of, not foreclosures, but of evictions. So we do want to keep our eye out on what's going on in the eviction world. Development for 2021 is expected to be robust. We want to keep an eye out on Class A vacancies, because we can see in 2020 there was a ton of Class A and a lot of new builds when it comes to multifamily. When we see a lot of units come to the market, we see that the vacancy rates rise, and when there's higher vacancy rates, then rents tend to decrease. There's not a lot of people looking, so they tend to give more incentives for people to move into the property, which increases the incentives that they give. So we're going to keep an eye on that, and I will definitely keep you guys updated on what's going on with that part of the economy. And one of the big hurdles that we are facing right now in the multifamily world is the disconnect of buyers and sellers when it comes to pricing. A lot of buyers think that they will get a pre-COVID discount, is what I like to say, of what their numbers will look like now compared to what they would have purchased before COVID. And sellers aren't giving that discount. I would say I've read somewhere that is about 6% of sellers are actually giving a discount when it comes to discount on selling their property, or going down on the price of the asking price. So that's my newsletter. That's all the information I have for you. Hopefully this information has helped you out, and this education has informed you enough to know what's going on. I know you may not be looking to buy, sell, or invest into real estate, but my name is Keenan Starks, and if you have any questions, please reach out to me. I'd love to help. Thanks for watching.